A major conflict has erupted between Canadian investment fund TGV and Israeli startup GEOX, highlighting some serious allegations about transparency and trust in the startup investment world. But here's where it gets controversial. TGV is not only accusing GEOX of misleading its investors, they are demanding to undo a $1.5 million investment and hold the company's directors personally accountable if the agreement stands. The dispute centers on claims that GEOX, during its 2024 Series A funding round, presented a picture far rosier than reality. According to the lawsuit, TGV asserts GEOX systematically provided false information, including inflated revenue figures, purported agreements with major clients, and overly optimistic growth predictions, projecting an IPO by 2029, thereby creating the impression of a highly promising investment. Adding fuel to the fire, TGV's decision to invest was influenced by the participation of Flashpoint Venture Capital, which itself had invested $8 million based on the same data. In December 2024, TGV formalized its involvement by signing a $1.5 million investment agreement, receiving around 54,000 shares in GEOX. However, the plaintiffs now argue that these numbers were grossly exaggerated. Contrary to the image GEOX painted, the company was reportedly losing customer contracts, incurring a monthly cash burn of about $500,000, and deepening its financial deficit. The fund claims the annual recurring revenue, ARR, was overstated by approximately 50%, and the alleged large client deals simply did not exist. Further complicating the matter, TGV alleges it repeatedly requested detailed supporting documents and accurate business data from GEOX, only to receive incomplete or insufficient responses. This lack of transparency has only intensified the fund's mistrust. Meanwhile, amidst these accusations, GEOX publicly announced in September 2024 that it secured a $19 million funding round. The company named key investors such as Flashpoint Venture Capital, RD partner SureTech, and private investors Ariel Maeslos and Noam Lanier, emphasizing ongoing confidence from the investment community. For context, GEOX was established in 2018 by CEO Itzik Lavi, CTO Eli Lavi, and Guy Adder. The startup specializes in developing a platform that assesses real estate risks stemming from climate-related disasters. GEOX technology uses 3D analysis of aerial images to automatically evaluate buildings, estimating potential damage with high accuracy. This system provides critical data points that are especially valuable to insurers, including roof dimensions, types, condition, slope, and more. In response to the legal claims, GEOX expressed optimism about its ongoing progress while regretting the lawsuit from what it described as a dissatisfied investor. The company stated it is carefully reviewing all documents related to the case and plans to respond appropriately. This situation raises important questions about accountability in startup funding and how much investors can rely on information presented during raising rounds. Could this be a cautionary tale for other venture funds? What standards should be set for transparency, especially when millions are on the line? We invite readers to share their thoughts. Do you side with TGV's push for accountability, or do you believe startups deserve some leeway in early-stage projections? Join the conversation and voice your opinion below.